All right. Hello. Looks like we're still waiting for a few more folks. I do see with the markets going down, even the interest of the people in the markets also go down. It's pretty common. Seen that in every market, crypto market, stock market. That's okay. Everyone wants to, what do you say, ride the rising wave, but the real fun is going through these troughs in the market as well. So morning. So I want to start the session today with answering a couple of questions that came up in our previous meetings. One was around, uh, how to get started, mutual funds, ETFs, and all that stuff. I want to touch upon that. The other question, I think in a previous session, was around buybacks. Where do we find the information on buybacks? So I did find one website. We'll look into that. Other than that, I think we look at what's the macro side story is. While I was going through some of the macro stuff, I was also fascinated by all the talks that we see from Fed governors coming on the Fed fund rate and all that, and how does that impact inflation. So that took me to a rabbit hole of around how the everything operates in US. I guess probably for sure in US. I'm not sure, is it the same thing in all other countries in terms of how the money is created, right? When we say Fed is printing money, what do we exactly mean by that? Right? Of course, there is no printing. There is no printing of bills. But what do we mean by that when Fed says it's printing money? How does money comes into the market? Essentially, how the money is generated, and then how these Fed fund rates. Fed is increasing the fund rate so that they can control the inflation, but how? Right. So I did spend some time in trying to understand a real macro side of the money game. How the whole money flows around in the market, and who are the participants, who are the players. So do want to share that with you. For me, it was enlightening. It was a good reading to move away from, let's say, individual stock, but to take a step back and then look at, there are other very, very big players in the market that impact our portfolio. Fed has become one of the largest player in the market. So, and any of this money availability of money supply, whether you like it or not, it directly impacts the portfolio performance. So I did spend some time to understand what the heck, how it does and what's the mechanism of creating money in today's economy. So I do want to share that with you. And yeah, someone had a comment.
That's a good point, Vivek. And just this week, I heard a bunch of people, always complain. People always love to complain about the Fed, right? The Fed this and the Fed that. But then, I asked the question, nobody could answer. Can you imagine us being without central banking, or can you imagine a world without central banking, and how would that be? Because I think it would be even worse, right? And we don't realize, the kind of stability it brings. So, like I looked up what countries don't have a central bank, and it's just a very short list, and it's nowhere you would want to move, right?
Yeah, so I think there are pros and cons of it, because central bank hasn't been there for eternity. It only came in picture in I think 1930s or something. Prior to that, we had individual banks, multiple banks issuing their own currency. Yeah, so it got its own benefit, but some of the central banks have moved away from the sound principles of, I would say, economy, or sound principles of money. And I think that's where a lot of concerns are coming from a Fed side, right? So we'll dig deeper into what's the whole concept of money, right? Today, there's nothing backing these money. You can just create out of a thin air and all that. So I do want to go through the whole process of money creation in today's economy, and then how it impacts, and why this Fed funds rate any changes in Fed funds rate is causing so much havoc in the market. Right. And I think then we'll end up the session by looking at two companies earning, and then we'll. Meantime, any questions, etc. Let's have some more discussion around that. Right. So that's the overall agenda that I had in my mind. Anything else you guys are interested in? Anything else that caught your eye during the week? I wasn't very close to the markets this week. That's why I have only 2 earnings to review. For this whole last week, I was a single parent. So with the work and with the kid at home, market was my priority. It was down in my priority. So, but yeah, anything else? Any other topic you want to discuss? Bring it up. Okay, so let's dive into today's session number 152. Yeah, we are marching along. Hope to see this 200, and by next 2023 we'll complete 200 sessions. So thank you. As always, this is only for education and entertainment. Please, no financial advice or tax advice. We do talk about all about finance, but nothing is a financial advice over here. So like I was mentioning earlier, before some of you joined, I do want to start the topic with answering a couple of questions that was raised in some of the previous sessions. One was around, going back to the basics of how someone who's new in the market, could get started for investing perspective. I think the special questions was around what are the ETFs and what is this mutual funds. So I thought I'll spend some time on that, answering those. If you have any more questions around it, we can talk about it. But again, and I don't want to talk anything theory, so I'll take my own example of how I started my journey in United States. I haven't been around in United States for many years. So I landed in this country in 2009. That's when I thought, okay, I want to call this country my new home. Came here for my work, and then wasn't really sure that I really wanted to stay longer here. So we didn't do anything for a couple of years. In 2011, our family, we decided, okay, this is good. California is good, because I had a earlier short stint in US way back in 2004, and I was in New Jersey. That was my first experience in life with snow, and that was too much snow for us as a family. My kids were, she was pretty young, very small, and had some issues with the extreme cold on New Jersey. I really didn't like it. I'm like, okay, I'm moving out of US. 2009 came back in California. I'm like, this is good. I think I can stay here. And so we decided to call this country our new home, and started our permanent residency in 2011 and received that in 2012. So for first, I was invested in Indian market, but not in the US side, because I wasn't really sure that I do want to stay in this country. So I didn't do anything for 2009 till 2012 until I got my permanent residency. And then we decided, okay, now we're going to stay here. Let's get active into the market. So first thing was, housing prices is too expensive. Paying rent through the nose was bad. So let's first look at a house, right? So like I always been saying, if I need money for next 3 years, I don't want to put it into the stock market. So I started saving for a house, and then didn't touch any of the individual stocks. So then I started in 2013. I started my first step into the US market. Started looking around, okay, how do I get started in this market? Didn't have much of the time for individual stocks. So first step which I did was to look at an ETFs, right? Or a mutual funds. And that's where I started exploring. And as an individual investor, if you don't have a time to, number one, to research about a company, there are 2 ways. Either, you can subscribe to some good research reports, or I do talk about nowadays some individual stocks, because now I am able to spend some time. You can listen in there. But more important than knowing about the stock, you need to know how your profile is. Are you okay to go through the volatility that individual stocks provide, right? Now, everyone's situation is different. You may need some of the money from your investing at some point of a time, and individual stocks could go anywhere during that point of a time, right? So for me, it was important that I didn't have much time for individual stocks, and so I started my journey with the ETFs, right? So there were questions around mutual funds and ETFs. So let's touch upon that, and I will talk about which are some of the ETFs that if you are a new investor, you could start with, and then there are many other ETFs that I discovered later. So there are two ways, and again, mutual funds and the ETFs both kind of a similar, not exactly the same. So when you buy into a mutual fund, you are investing into a basket of stocks all tied together under one particular fund, right? So if I want to invest in Apple, Google, Microsoft, Berkshire Hathaway, and Chevron and Exxon, and let's say all top 500 companies, but I don't have that much amount of money to pick individual shares of each company, I can simply go and invest in a mutual fund that has exposure to 500 companies or S&P 500. Right? So that's a mutual fund. Mutual funds have been around for more than 100 years. These are managed by people called fund managers, very smart people with great degrees from the best business schools. And Fidelity, Vanguard is the lowest cost leader. So if you really want to invest in mutual funds, Vanguard has the ones where the fee or the cost is very less. And over a period of time, and I will share a report, over a period of time, the biggest difference between the mutual funds that beat others is mostly around the cost. Lower the expense ratio or lower the cost. That's what is the alpha that you generate on mutual funds. ETFs. Similarly, ETFs are also a similar instrument in which you can invest in an ETF. ETF is called Exchange Traded Fund. These are a little newer instrument launched in 1993. So it hasn't been around that long, when we look at the whole history of the US stock market. And the first one ETF was SPY, which is nothing but the ETF that invests in top 500 companies of US on a US market. And the difference between, let's say, this ETF and this mutual fund is that this ETF just tracks an index, S&P 500. It is passive, right? There is no need of a fund manager. We don't have to hire a B school graduate fund manager and pay their salaries, etc., because all this ETF does is just tracking this index. So this is called passive managed. There is no active management. Means a fund manager decides that, okay, you know what, I don't want to have exposure to Apple so much. I want to take Apple out. They cannot, because all they are doing is, and I don't, in this case, even the fund managers don't do anything. It's the computers that buy and sell the stocks based on how the overall S&P SPX index performs. Right? So because there is no overhead of expensive fund managers, these ETFs rose in popularity and starting getting a lot of a market share from the mutual funds. The mutual funds earlier were mostly actively managed, means the fund manager would decide what to buy, what not to buy, and having a person making that active decision. The whole point was that they will be able to beat the market. But over a period of time, we are seeing that hasn't happened. So ETFs gain a lot more popularity. Yeah. So there are different types of ETFs available. Total market ETF, VTI, is from Vanguard, which is total market index ETF. Then you have SPY, which is S&P 500 ETF. IWM, which is Russell 2000. It tracks the index of Russell 2000. QQQ tracks NASDAQ 100. So these are at a market level ETFs. Then you also have ETFs which are sector specific. Right? Great. I think I'm more comfortable in real estate sector. Right now, instead of me trying to pick individual real estate companies, can I pick an ETF or / a mutual fund, right? Now, I will look at some of the differences between mutual fund and ETFs, but please note that for me personally, I don't own any mutual funds. Now, I think because the ETFs are such a great vehicle, I hold ETFs in my portfolio. So I won't dig deeper into different types of mutual funds over here. Okay. But yeah, if you have a different experience on owning mutual funds, that's great. There are some investors who would like to own mutual funds because they do want someone to be actively managing the investments, which I think when the markets are bad, let's say in 2008, I assume that those actively managed mutual funds did outperform the market. But I think over long term, the data is not in favor of those actively managed mutual funds, especially when you include the cost of that servicing. Right? So let's look at a quick difference between mutual funds and ETFs. So when you buy or sell a mutual fund, you don't get a mutual fund immediately in your brokerage account, because those are settled at the end of the day, right? Yeah, and that's called a net asset value. But ETFs are traded on exchange. That's why it is called exchange traded fund. So you can buy it any time of a day. You can sell it at any time of a day. It just trades like stock. Right? If you don't know that it's actually an ETF, from your trading perspective, you won't feel any difference between ETF and the stock. Next topic is around transparency. Mutual funds publish their holdings quarterly. So, but we'll get to know after 30 days, what does this mutual fund holds. And nowadays, there are some mutual funds which are passively managed. They also track indexes. So I don't even know why do those mutual funds even exist that track indexes? Because hey, you can do it. ETFs is much better way of doing it. ETFs, they publish their holdings on daily basis. So there is more transparency. When you're investing in ETF, you can go and look what those ETFs hold today. So let's let me just, okay, I think we can go to some ETFs and pick up. Okay, let's say I'm going to this ARKK ETF, right? So if you look at ARKK ETF, you know it's where is this holdings? They should publish their holdings on daily basis. Oh, come on. ARKK. Oh, I'm on ETF.com. ARKK holdings. There we go. So these holdings are published on daily basis. So, you know, this is as of 11/18. What does this ETF hold in its portfolio? Mutual funds will publish it every quarter. Right? When you invest in mutual funds, you might have some minimums, right? Minimum, depending on the fund, it will minimum $100, $1,000. But on an ETF, you just need to buy a share. And if your brokerage allows you to buy fractional shares, then you can even buy on a fractions, right? Transparency of trading cost. So when it comes to the mutual fund, all the mutual fund holders, let's say if I buy or sell that mutual fund, there's some cost associated with it. But that cost is divided over all the mutual fund holders, because that impacts the net, you know, at the end of the day, the net asset value. And even if I have not bought or sold anything, just because someone else has bought or sold anything, or the cost is distributed over all the mutual fund holders. But in case of ETFs, whoever is trading only bear the trading cost, and others are not impacted. From a tax perspective, ETFs are more tax efficient. whereas the mutual funds are not. And this is something which sometimes, becomes a little surprising, is that you, depending on, sometimes what happens is, in a mutual fund, the portfolio manager could have sold a particular holding in a mutual fund that was profitable. So you might get hit by capital gains, even though your overall mutual fund is still in loss, because the rest of the holdings in that mutual fund is at loss. But one particular, let's say if there's a mutual fund that has got Apple and got ARKK in it, right? So now ARKK, because it's been down, whatever, 50-60% over the year, and it's got a bigger allocation, your overall mutual funds, if you had invested in that, probably is down as compared to last year. But if the fund manager decide to sell Apple and take a capital gains on Apple, you'll still be hit by the capital gains tax, even though your overall mutual fund is down, right? So it's not tax efficient. When it comes to the expense ratio, and this is where I want to focus a lot, is around the expense ratio, because over long term, the difference between the performance is generally because of the cost of operations. ETFs generally are lower in terms of your expense ratios than the mutual fund, right? Liquidity is, I would say, this depends on what kind of ETF you have or what kind of mutual fund you have. I have seen some ETFs which are less liquid, and some ETFs which are highly superly high liquidity. But now it comes to the performance. About 80% of all actively managed mutual funds underperformed in 2021. So 2021 market gained almost 28%. Still 80% of the actively managed funds, they underperform. Now the question is, we really want to beat the market, you have to really fish out for those 20%, which is very, very difficult task. The trend is similar, even not just for 2021, but even for the longer period of time, right? So the whole idea of the actively managed funds was that they will beat the market, really hasn't come true, especially if we after include the cost of owning those mutual funds. So then those mutual funds also decided that, when they saw that a lot of money started to flow into the ETFs, and many of those passive ETFs which just track the indexes, mutual funds also came up with their passively managed mutual funds, which at least do better than the actively managed mutual funds. But I don't know what's their reason for existence in case of when we have ETFs which are passively managed. So just 26% of all actively managed funds beat the return of their index rivals through the decade over December 2021. So even for last 10 years, only 26% of the mutual funds or actively managed all funds beat it. So if you're new investors, maybe just pick up any passively managed ETF. Right? Now, the investors who buy active fund can improve the odds by choosing a low cost option. So you really have to find out which one with the low cost, because that's where the most of the difference comes out to be. As you said, this is average, yes, of all actively managed funds. Correct. Would be interested to see how top 10 or so percentile of actively managed funds do. Yeah, let me try to Google and see if I can find something else. Yeah, underperformance tends to correlate to the higher cost. We talked about that earlier. Fees are a big reason why index funds typically outperform, because there is no one to manage those. Those are passively managed index-based funds, and that's where they tend to beat their active brothers and sisters. The average asset weighted fee for an index fund is 0.12%, whereas for active funds is at 0.62%. One thumb rule for investors to follow: an active manager must have 10 years of market beating performance to make a convincing case for skill over luck. Okay, there's one report that I came across. Let me see if I can pull that out. It talks about the scorecard, and let's see, maybe it has got some actively managed stuff or not. So this was done in 2021. So even if you look at percentage of all domestic equity funds, now this looks at all the equity funds versus the index funds of S&P 1500. 2009, like 40% had underperformed. It means at least 60% had outperformed the index, right? Because those were some 2000. Okay, so let me look at, so 2005. So this is not in chronological order. So right now, 2021, it's 70, almost 80% have underperformed. So let's look at 2020, 57%. Yes, because 2020, those were the, when the markets are in turbulence, the active funds should do a little better because there's someone who's actively managing that, trying to use the strategies to reduce the losses. 2019, 70% underperformed. 2018, 68% underperformed. So in 16 of the 18 categories, more than half of the funds underperformed their benchmark. Let me see, are there any other statistics? Over 20-year period of a time, 90% actually underperform their own benchmarks. So benchmarks means if I'm starting a mutual fund and I'm saying, compare my performance with Russell index. So that's what they call as a benchmark. And now at the end of a year, you should see how my mutual fund has done as compared to the Russell index. Sad to see that over a 20-year period, 90% of the funds actually underperformed its own benchmark. I mean, it's the test. It's like, I am telling you, test me against this. And then 90% of the time, overall on mutual fund industry, 90% of the students actually fail the test that they set up for themselves. But, the industry is still big because, it generates a lot of fee for fund managers. And that's where these Fidelities, they make money, and shops, they make a lot of money on mutual funds because that's a big fee generation for them. But from a performance perspective, performance hasn't been that great over a long period of time. I think, yeah, that's another one I wanted to share. So top 10 mutual funds. Let me look at the Asif's question. Let's search for top 10 mutual funds by performance in the last 5 years. Not top rated. Okay, let's pick up this top 10 mutual fund that had the best returns of the decade. So Fidelity Select Technology FSPTX, 10-year annualized return in 16.73%. It is a tech index. So let's see how QQQ did over 10 years. QQQ is a performance over
that previous page. What was the date as of? Is it as of end of 2021 or?
No, okay, so that's a good point. This is 2020.
Oh, September.
Updated as
Okay,
on 2022.
Because
So
this year impacts a lot.
yeah. I mean, this year also impact QQQ as well, right? So does it show 10-year performance anywhere? And again, some of the mutual fund could pick, let's say if this mutual fund had very specific, let's say Apple, probably it will beat QQQ. But let's see, where is this charts? 10-year, 17.46, right? So even one of the best performing mutual
You know
funds.
that site we found a few weeks ago called Portfolio Lab. It's a nice way to show If you type in Portfolio Lab, I think it's .io or something. But it's a free site, and they put in a database, Portfolio Lab.
Labs.com.
Yeah, that one, because it shows you a basket of stocks or ETFs and how they've done. And I like they have sharpened Sortino ratios and all that kind of stuff.
Yeah.
So.
Oh, that's good. So yeah, so over, I mean, and there may be funds because let's say only 80% have underperformed. So 20%, we might find some 20% funds that have overperformed. But as an individual investor, I mean, I don't have a time to go and try to hunt for those 20%. Right? So I mostly have been an ETF guy and focus, when I started my journey, like I said, I started with, if I recall correctly, I think I started it was in 2013 because I was saving for a house, and the market could go anywhere for next 2-3 years. So I didn't want to put anything in the market. So I started my journey in 2013. I started with SPY because that's a broad market index. For me, working in tech sector, I was interested in QQQ. Coming from India, we like gold. Generations, my parents, my grandparents, everyone loved gold. So gold's I was still, I was still attracted towards gold. So I picked GLD as ETF. 2009, 2010 were not great for US. What had happened? So had some doubts. Maybe US will, lose its a dominant position in the market. So I need to go outside US. So I picked up EEM, which is emerging markets. Then I also remember I picked up developed markets outside US. It's a VGA or VEA. There was some fund, developed market ETF outside US. I can't remember. There was one of them, VGA or VEA. There was, it should have been VEA. Okay. So I had VEA, and which else did I have? I had 7. I wanted bonds because, the 60-40 is that you should have a stocks and you have a bond. So TLT is what I had for my bond exposure. 1, 2, 3, 4, 5, 6. 7th one was which little rotation, when I used to think, okay, I want to get into real estate. I think I picked some real estate. Someday I picked up some metals. So I think I picked some XLB. So 7th was a little floating one. And that's all I started with 2013. And every month I had decided, and if you are starting your journey, decide how much you want to invest from a proportionate perspective. So I had decided like 25% goes to SPY, 10% goes to QQQ, 5% goes to GLD, and do that investment, on regular basis. Until in 2015, when I started looking at individual stocks, all I had was like 6 or 7 ETFs in my portfolio, right? And that did pretty well for me. So you really don't have to, if you don't have time, you really don't have to go and try to pick individual stocks, especially in these volatile markets, because the individual stocks are very volatile. But even with the ETFs, life can continue to stay good. I mean, for my kids on their account, I'm like, just pick SPY. Don't have to think about anything else. Just keep SPY for now in your portfolio. You guys have like 30 years, 40 years. So it's a no-brainer. Don't have to think a lot more about what's the, new shiniest metal, or what's the currently, the fashionable company in the world. No need. When I started using options, and I started my journey in options around 2016, started getting deeper into options. There I started picking up a lot of these sector ETFs because this allowed, and these are very liquid ETFs, and it allowed me to get exposure across different sectors. And then I started looking at many of these sector specific ETFs, right? So if you are interested in taking energy exposure, right? Like I've come and talked about that. I don't have much expertise into analyzing, energy industry, right? I feel good on the tech side. Energy side, not that great. So if I'm looking for my energy investment is in XLE. Looking at expense ratio, it's like 0.1%. I find all of these a select street ETFs to be pretty liquid and good optionable. Now, there are some people ask questions of why I don't focus on the Vanguard ETFs. Even though Vanguard ETFs might have lesser expense ratio a little bit, but they are not good in terms of when it comes to the options. Right? The liquidity or when it comes to the option, the bid-ask spread is really very wide. So ever since I started looking into options, I started focusing on which ETFs are more liquid in options market. Where can I get tighter bid-ask spread? So that also drives my decision, and that's why I focus mostly on SPDRs because they are pretty liquid. Right? So today my current portfolio, I hold XLE, I hold XLF. I think these are the two ones which I hold. I hold KB, not the KBE. Yeah, I had played in XRT, XOP, but don't have that right now. Of course, S&P is my top top holding is S&P 500. So now ETFs are also actively managed. Some ETFs are actively managed, some are passively managed. So if you look at some of the actively managed ETFs, so the more and more specialized you become, the cost goes higher and higher, right? So let's say look at S&P 500, its expense ratio is close to, I guess, 10 basis points. Right? Now, these are the bigger sector ETFs, right? Real estate, materials. Their expense ratio is 10 basis points. You become a little more specialized, right? In real estate, I want to focus on home builders. You got to pay a little more for it because now, your expense ratio becomes 35 basis points. In energy, you want to focus on gas and equipment, exploration and production, higher expense ratio. You become a little more specialized, looking at ARKK funds. Their expense ratio is like 75 basis points. ARKK is 75 basis points. Right? So more wider you go, the less is the expense ratio. Yeah, S&P expense ratio is only 9 basis points. Right? So to start with, I would say ETFs are a good instrument to start with if you don't want to go on the don't want to face the volatility of individual stocks. Okay, hope this helps. Jaya shared the latest SPIVS scorecard 2022. Thank you. Any good list on which ETFs get 1256 treatment? I know that the index fund, index ETFs, they have 1256 tax treatment, like SPX, RUT, NDX. These I know for sure they have. GLD has 1256 treatment. Let's search for it. GLD, I'm not sure, and I've looked at it. 1256 tax treatment ETFs. The reason why I started focusing on the index was one of the reasons is because of these. Does it have a list? No, maybe I'll. Okay, does the gold is taxed at 28%. Yeah, looks like the GLD is taxed as 1256 contract. Yeah, maybe in next session. So if I can find some more information on this one. But I know that index ETFs, they are all 1256 treatment. Cool. All right, so that's a quick primer on mutual funds and ETFs. Like I said, I am more of an ETF guy, and because of the low cost. Some of the mutual fund could also be, I know one of the Fidelity's S&P 500 was actually less expense ratio than SPY. So you might have to really, if you're a Fidelity customer, just compare the Fidelity's, I forgot what's their S&P 500 fund was, but that was even better than SPY expense ratio. So I would rather pick that over SPY. Cool. Expense ratio may not be that important. For example, SPY versus WU, SPY 20 times the liquidity, WU is much better. Yes. So Steve, that's what I think. If you are just buy and hold, you don't do options, or you're not worried about liquidity, then expense ratio is the only criteria. Now, ever since I started looking at doing options, I have to look at which are optionable and how great the liquidity is in options. What's the bid-ask spread? Because that allows me to continuously, reduce the cost basis. So now when I'm looking at it, I'm looking at from a both perspective is optionable, and which include all your liquidity, your tight bid-ask spread, and all that stuff. You're 100% right. Okay. Other question that we had in one of previous session was list of buybacks. Where can we find it? Only thing I can find was this. It talks about buyback announcements that have been done. So I forgot who asked this question. Well, let me paste this URL in the chat. But I do recall someone asking this question on where can we find a list of buybacks. Okay, that completes okay, all right. So Ramesh said that. So that completes the action items from our previous meeting. Let's jump on to today's session. Macro side, recession indicator hits 4-decade high, which is nothing but our yield curve. So yield curve inverted further during this week. So I bring up my yield curve inversion. Let's look at 20-year versus 10-year. Where's my 10-year minus 2-year? I didn't look at 10-year minus 2-year. So it did invert further. And let's say look at max. So in 1981. Yeah, so now it's closer to where it was over here in 1981. So yeah, yield curve inversion is, if there is any indicator which gives a reliable signal around recession, it's a yield curve chart. And then we also saw President James Bullard saying Fed terminal policy could actually reach at 7%. And I remember ever since we started tracking this, it started moving for 4%. I recall it was like 4.69% was the terminal rate. That would be in 2023. Then we started hearing about, no, it's going to be 5.5%. And now this week, they say, oh, it may need to go as high as 7%. Right? So to control the inflation. And markets didn't like that. So they kind of, over this weekly period, we haven't done much. The last week was a great week for the markets, but this week we just closed almost where we were, maybe slightly down, because all the enthusiasm from a previous week was dampened by comments from a couple of Fed presidents or governor who are. Nowadays, they move the market a lot more than the companies and their actual earnings. These interviews cause a lot more volatility in the market. Okay. So I got in question, why Fed increasing the Fed rate will slow the inflation, right? Why? How this whole thing works? So that got me into a journey of trying to understand, how this whole money works in US. What do you mean when we say Fed is printing money or pumping money? So in 2020, there was, this whole money printing going brrr was a good meme. And then even on 2021, we saw everyone's talking about Fed is printing so much money because of they're inflating their balance sheet. So that got me to think about how this overall process works. who are the players in this process, and then why nowadays we talk so much about Fed rate, and why go back in history. Historically, the Fed rates changes didn't impact stock market so much as it is doing right now. So what changed? Over the past few decades, some things would have changed. So that got me looking back in history, trying to understand how this whole money stuff works in US. Okay, so let's start with that. Clearly, what we saw in 2020, and there are three big players in this whole game. I would rather call it a game, because that's what it seems to be. One is the government, government that needs money to fund its expenses. We saw it in 2020. Or you want to go and do, send the stimulus check, where the money will come from. Government needs that money. Then we got a Federal Reserve. And when I say government, it's our Congress and plus, let's say, Treasury. The Treasury work for Congress. And then there are banks that you and I, we know. We don't deal with Fed, but we deal with JP Morgan, we deal with Bank of America, Wells Fargo, what, blah, 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 blah. These are the big so-called money center banks in US that we deal with. So these are the three big parties which is involved in printing, pumping money in the economy, and how it gets back or it gets out of economy and all that stuff. So let's try to dig a little deeper into how the whole process works. So in 2020, when government announced the stimulus checks, and they say we need money to, whatever, $4 trillion and whatnot, those absurd numbers. How do they get that money? So when government needs money to spend, they reach out to the Treasury. Treasury is a department of government, works for the government. It is the government. And Treasury issues what is called bonds. This is called Treasury bonds, right? So bonds it's a generic name. And if you recall some of our previous sessions where we dig deeper, we have a T-bills, T-notes, and Treasury bonds, right? But collectively, we just call them bonds. Bills are short durations, less than 2 years. Notes are between 2 to 10 years. And if the duration is more than 10 years, it's called bonds. But for convenience sake, let's call Treasury issue bonds, which is nothing but a promise by the US government to pay a certain rate of interest to the holder of these bonds over a period of time, right? So if you are looking for bonds over a 10-year or let's say 4 weeks, which is the T-bills, or 8 weeks. Oh, by the way, yeah, I do want to update my first ladder of the T-bills now matured on 15th. So I recreated into a 17-week ladder, right? So one of our previous sessions we talked about T-bills ladders, right? So yeah, so I picked up T-bills because I moved money from my money center banks, which pay nothing, and T-bills actually are paying 4% APY. So why not? So that's become my place to park the cash. So anyway, yeah, as an individual investor, yeah, I buy T-bills. If I buy notes for 2 years, yeah, I'll buy it from a Treasury. But majority, when the government needs money, they'll basically ask Treasury. Treasury will create create bonds and auction the bonds. Now, when I say auction the bonds, who buy these? These bonds are bought by either individuals like us, but we don't move the markets much. It's the foreign countries. The other central banks will buy these bonds. Foreign central banks, institutional investors, right? Corporates, Berkshire Hathaway has $130 billion of cash. All is invested in Treasury bonds or Treasury bills, right? And now we have seen in past few years, one of the biggest player is our own Fed. Right? There are foreign central banks. There are sovereign wealth, sovereign funds, right? If you look at Saudi's funds, they have got a PIF, Public Investment Fund. Singapore has got a Temasek. I'm sure there's a typo. So similarly, many countries have their sovereign wealth funds. They buy treasury bonds, right? So now mutual funds hold it, pension funds hold it, but if they don't want to buy it, we saw in 2020, Fed stepped in a big way and started buying bonds. And that's why we see that when we talk about Fed increasing its balance sheet, that essentially it means that Fed is buying a lot of these assets. So, but how are these bonds sold? Your question is, if these are, if someone is buying these bonds, how these bonds are sold? So what Treasury does is they sell these bonds through these banks. Right? So now every bank, right, JP Morgan, Bank of America, have an account with the Fed, which is called, okay, let me now dig deeper into. So JP Morgan, let's say every banks have an account with the Fed, which is called reserve account. Okay. So now let's say Fed is buying bonds, $500 billion of bonds. Let's say they bought $500 billion of bonds through JP Morgan. Fed will credit the JP Morgan reserve account with $500 billion. Where did this money come to JP Morgan? From thin air. There's no printing of money. It's just that in a computers, you just update the ledger and say reserve account of JP Morgan now has got $500 billion. So suddenly JP Morgan has got $500 billion out of thin air. And who's guaranteeing that money? To government, these bonds, Fed is guaranteeing it because Fed is the, they can print money out of thin air. So Fed has to pay interest rate. Yeah, they can continue to pay the interest rate because they don't have to earn the rate from anywhere else anyway. They can just keep updating this number in the database. That's all. How is the new money created, right? Which is when you think about it, it's shocking. That is just printed out of thin air. It's just a number you can go and change in any account and ledger, and that's how you create a new money. So let's say when the Treasury issued whatever 4 trillion worth of bonds, and Fed bought those bonds, Fed went ahead and credited the reserve account that each of these banks maintain with it Fed by that said amount. So in this case, let's take an example of JP Morgan. So JP Morgan has got now $500 billion in the reserve account with the Fed. Right? Now, Fed has something called a reserve ratio that each of the bank is supposed to maintain. Right? So now the other side of the banks is you and I, right? Individual savers. What we do, we go and deposit our money into the CDs or into our savings accounts. Right? But we have to make sure, and the government has to make sure that when I want to go and withdraw that money, JP Morgan has that money available to pay to me. Now, not everyone will go and withdraw all the time. So what government mandates is that you should keep some money with Federal Bank, Federal Reserve, so that, let's say, if all the individual holders have collectively deposited $500 billion in JP Morgan, and let's say if you want to withdraw that money, obviously not everyone going to withdraw at the same time. Based on whatever logic, Fed decides that reserve ratio, which means, let's say, earlier it used to be 25%, means you need to have 25% of all your liabilities tied up in this reserve account. Means $100 billion is tied up in the reserve account. Or conversely, whatever money you have in your reserve account, you can go and kind of lend 4 times of it to other investors, or whoever wants to buy the loan. So the amount of money that JP Morgan has in reserve account, and depending on the reserve ratio, they are able to give loans to individuals like you and I, to corporations like Apple, or whichever small business need money from JP Morgan. So this reserve ratio, if it is, say, reserve ratio, if let's put it RR, if RR is 20%, and in my reserve account, JP Morgan has got $100 billion, then they can loan 100 divided by 20%. They can create a loans worth $500 billion. So now this money is available for JP Morgan for, let's say, for car loan, for personal loan, for any type of loans, corporate loans, etc. Right? So now this 500 billion just came from out of nowhere. So when government created these bonds, Fed bought these bonds from these banks. They use the channel banks as a channel. They credit the reserve account, and depending on the reserve ratio, now JP Morgan is authorized to loan $500 billion to the individuals of the corporations. So suddenly we will see, and that's why we saw that the loan rates went down, because now JP Morgan $500 billion that they can loan out. Right. So that's how when we see money created, this is how the money is created. Now suddenly there is more money available for everyone to go and buy, or to go and take higher loans from the banks. And now that what does is it increases our propensity to buy more, so that we can keep the economy chugging. That was the biggest concern in 2020, was economy will come to a standstill. So we wanted to pump up the economy, and that's how this whole money printing worked. Now this 20% or 25% used to be in, I think, 1980s, 1970s. In 2020, this reserve ratio was brought down to 0%. Means legally, the banks are allowed to give loans at infinite level, right? You don't have to have any reserve ratio. They can loan out as much as they want to. Right? The only reason why banks are not doing it, because they probably are concerned that if we loan out too much, are we going to get back that money or not? But legally, and someone can now fact check it if that has changed or not, the reserve ratio in 2020 was actually brought down to 0%.
Today it's still 0, or
I don't know now if it is 2022 what the reserve ratio is. Let's check it out. Reserve ratio. The ratio 2022 or current now. Okay, this says now it is designated reserve ratio on the Fed reserve ratio. It's a 2%. Now this is looks like this is the FDIC, and we're looking for Fed. Well, this reserve ratio, this is where the FDIC is securing our deposits in the bank. So if there is a bank run, FDIC only have 2%. The 98 of the people, or 98 of the CDs that are in the bank, or 98 of the money that is in the bank will not be, those depositors will not be made whole because FDIC reserve ratio is 2%. But we can look at what's the Fed currently is. So legally they can loan out based on the reserve ratio. So when Fed, let's say, now the other question is, if Fed wants to tighten the money, why can they not increase the reserve ratio, right? Increase the reserve ratio back to 25%, so that the banks will have to hold that much amount of money in the reserve account, and that money will not be available to loan out to the consumers, right? B asks, what's the meaning of money if it can be created out of thin air? So today, the meaning of only money is, hey, US government will just keep paying me. This is the whole basic concept of fiat money, right? It's a money because the government has told it's money. Otherwise, it has got no value. It is just created out of thin air. And last week, I was listening to another podcast where they talk about, a little digression, IMF does SDRs, which is called special drawing rights, which allows a certain countries to draw money, to draw dollar, or to draw, let's say, I call it money, from IMF. And how this IMF creates SDRs is out of thin air. They have no bank balance or etc. They just create out of thin air because the governments that's involved in IMF, and they basically use a basket of currencies, and those Fed or the central banks of those countries, they say, yeah, go ahead and create those SDRs, because eventually it's just a number in some system. You don't have to work to create the new money anyway, which was a revelation for me. But anyway, this is how that's so-called a fiat money. But it is money because government says so. Government can create it out of thin air and then tell you, hey, this is valuable. Anyway, coming back to our discussion around, I'll tie it back to why the Fed fund rates have become important, right? So why not just increase the reserve ratio so that JP Morgan or Bank of America has less money available to loan out? It used to work, and those who have been in US way longer than me can go back and check. But this is in earlier decades, 90s, 70s, 80s, 90s, changing the reserve ratio used to be the tool with Fed to control the money supply, right? But not any longer. Prior to 2008, controlling reserve ratio used to be the tool in which Fed will control the supply of money available in the economy, means available for you and I or corporates to use. Post 2008, it doesn't work anymore. And the only thing that changed in 2008 and has been continuing since then is QE. First time the QE was done was in 2008. And it was supposed to be one time only. And, if you look at the governments, the one time only stuff never says one time. And then we did it we have been continuously doing it like crazy, QE. Now, because of this QE, this is the cause of this money printing, the available amount of money in the system is so big that changing reserve ratio won't impact much. Okay, so I think I do have a note somewhere saying in 1970, reserve ratio used to be 25%. Right? But now it doesn't work anymore, because the reserve accounts has already swelled so much. The reserve accounts that banks have with the Fed has become so big. Now there are trillions of dollars in the reserve account. Even if you, let's say, increase the reserve ratio by 10%, if there are $9 trillion in the Fed balance sheet, if you increase it by 10%, you still have $8 trillion, which is huge. So how the Fed will control the money supply? So Fed now coming saying, you know what? I will start to pay interest rate on the amount that Mr. Jamie Dimon or Mr. Bhaim Monahan, you keep in your reserve account over and above the mandated reserve ratio. So if the reserve ratio is 0%, then as a bank CEO, any money that I keep with the Fed in reserve account means the money that I cannot loan out will earn the Fed rate. Getting me? So that's what when we say, no, Fed decided to pay this interest rate to the banks on the money that they're keeping in a reserve account. I'm like, this is the best business. If you really go back to the history of how the reserve account money came in, banks didn't have to do anything. It's a treasury government wants to get money. Treasury basically creates bonds. Those are sold through the banks. Fed credit the account of the bank, which they have a reserve account. Banks didn't have to do anything. Of course, maybe they have to facilitate this. And now they're starting earning interest rate on the money that they got as a gift from the government, and they didn't have to work for anything.
But because the reserve is zero, that means they make the money on the whole amount.
Exactly. Right now, the reserve is zero. So any money that you keep in your reserve account, it's starting to earn, dollars for the banks. So when
now the choice of a bank is either make a mortgage to someone at like 6% or keep it with the Fed at 4 or something like that.
Bingo. That's exactly what it is. So now banks have to decide, should I pay out? Why will I pay, mortgage at what I was, so if the Fed is giving me 4%, Fed is the best borrower, the most secured borrower in the world. And that borrower is paying me 4%. Why will I loan it to someone mortgage at 4%? No, because that's risky. I want more than 4%. Why would I loan to someone for a car payment at less than 4%? I can easily earn 4% by parking my dollars in the reserve account. So that's why when Fed increase the interest rates, banks' propensity to loan out that money goes down. Because now every borrower, you and I, we are competing with the Fed for 4% or whatever that amount, that Fed fund rate is. So unless we are willing to pay as an individuals or as a corporate, unless we are willing to pay higher than 4%, banks have zero incentive to loan that money to us. So then what happens? Corporates cannot get the loans at a cheaper rate. If they need that money to grow their business, they'll start to fire employees. That's what we are seeing. A lot of these tech companies, now they can't get money at 0% or what, earlier these Fed rates were close to zero. So these corporates were able to raise the money at, let's say, 50 basis points, no more. You and I, we were able to get a mortgage at 3% for 30 years, no more. Because now Fed is sitting saying, I'll pay you 4%, Mr. Bank. So then why would bank loan it to me and not to the Fed? So now we are seeing corporates, cutting down on their expansion plans, because that's where we see the cost of money, the cost of borrowing for us has gone higher because the Fed has increased the fund rates. And this is how now the Fed is trying to control the money supply available to you, to me, to the corporates, to the economy by changing the Fed fund rate. So now us as an individual, we're going to postpone our purchasing decisions. I'm not going to buy home at 7% mortgage anymore. Right? So I'm going to postpone my home buying decisions. That would impact, let's say companies like which are involved in the whole, the big part of the economy is buying home. You got appliances, you got home builders, everyone, right? So when as a consumer, I start to reduce my demand, it'll start to impact the economy. The demand distractions will set in. Right? This Halloween, I think I was talking just after the Halloween session, I didn't see many kids, coming for trick or treat, because because the cost, I mean, the home, the individuals are stretched for their uh, for their budgets, so this is what is leading to demand destruction. So if the demand goes down, what happens to the prices of the goods? It will go down. The other way to bring down the prices of the goods is to increase the supply. But unfortunately, Fed has got no control on increasing the supply. It's a China which has a control on increasing supply, because that manufactures most of the things, right? All the manufacturing is not done by government entities. So Fed can't control the supply. Only thing they can control is the demand, and they're trying to control the demand by controlling the Fed fund rate, which makes it more and more expensive for individuals and corporates to go and spend it, and hence will bring the demand destruction. It will bring the prices down. Prices come down means inflation goes down. All right. So this is what I learned, trying to figure out what the heck is happening. Why is Fed fund rate is nowadays, there is so much talk about Fed fund rate to control inflation. This wasn't the case in 1980s. Exactly, that's what I got to know. I wasn't here, so I don't know. Even if I was here, probably I was a kid. So anyway, so this is how the whole money supply works. And nowadays, why the Fed fund rate has become such an important tool in controlling the inflation. I know this was a little different from what we generally talk, but I thought it's an important thing to know that this money that we create it's just out of thin air. So yeah, from a different angle, increased mortgage rates can be needed, balancing force to revert housing market to a historical mean. Yeah, I mean, we'll look at some of the housing charts, and already there is some demand destruction. This is happening, right? So earlier, and there's another interesting chart was earlier, the treasuries that the the Treasury Department used to sell the bonds, etc. Foreign holders, foreign central banks were always eager to lap onto US Treasuries. Slowly and steadily, we are seeing that the foreign banks are reducing their holding of treasuries. September 2021 to September 2022, Japan has reduced. China has reduced. So who is buying these treasuries over this whole period? It's the Fed who is buying those treasuries. So when Fed buy the treasury, they credit the reserve account of the commercial banks. Commercial banks come and loan to us. That's what we call as a money printing going burr, money being added into the economy. And now the Fed is increases the fund rate so that that additional money that came into economy is not lent out to consumers, but banks will keep it with the Fed, which has guaranteed payment of 4% from the most the credit rated buyer in the world. So that's how it works. Different discussion, and it is already 11:15. So took longer than I thought, but I thought I do want to share because I learned some new things while going through this today. All right, coming back to stock indices, not much change this week. So when does the government pay back the debt? So government payback as and when these are matured. So if you're having the treasuries, let's say if you have bought these T-bills or whatever, if you bought a 4 week later, government has promised you that they'll give you that % interest. And for government to give the interest, nothing is required, right? They can always get the dollars out of thin air. But what kills us is the purchasing power of the dollar is going down. So unfortunately, I mean, this is what it is, because these dollars are not backed by anything. It used to be backed by something useful, not useful, but it used to be backed by gold. But now you can print anything out of a thin air. So for government, interest rates, only thing I think that will preventing government for not going and, today we are able to do it because US dollar is a what do you call reserve currency. Rest of the world has faith on US government. The moment this faith is gone, it's going to come crashing down, because this whole path that we have embarked upon is a very dangerous path. We can keep kicking the can down, but I don't know how long we can continue to do this. Printing or creating money out of thin air. Somewhere there'll be questions asked saying, if we hold the dollars, let's say other central banks, we hold the dollars, and then US can print dollar anytime, then what's the value of these dollars? Unfortunately, every other central bank is doing the same thing anyway. So it's just like everyone is printing money out of a thin air. So yeah, let's see which is the most stable one. Okay, US is the most stable one. All right, we're going to buy US Treasury. So that's why we are still the able to have the highest position in the world economy, because the others are worse than us. It's not that this is a sound money principle. This is not at all a sound money principle, but the others are worse than us. So then, yeah, US is still on the top of the pyramid, I would say. All right, stocks perspective. Dow Jones was almost unchanged. And overall also, I think stocks didn't, from a week-to-week perspective, nothing much happened. NASDAQ is still closer to 29% down YTD, and S&P 500 is down 17%. Like I said, individual sector perspective, I think, of course, discretionary was down 3%. Overall market was lukewarm. Nothing much changed in the market. Day-to-day basis, yes, I think on Friday, there are some concerns after this Fed governors came and the presidents came and talked about 7%. So we lost some of the gains, but overall, nothing much happened in the market. All right, a few charts. Yeah, this is again a time and time again a reminder, is time in the market, not timing the market. So you're probably this time bored of me saying this, but I have to say this. And this chart again reminds us, if you're holding, and this is a percent of period that have earned a positive return, total real market return, 1871 to 2012. I think it still works for 2022 when you're looking at such a large amount in longer period. If you're investing in a market for a day, it's a 50-50 chance. Today market can be up, tomorrow it can be down. It's a coin flip. As you increase your holding period, right? Oops, who's calling me? As you increase your holding period, the chances that market goes up increases. So for 1 year, there are let's say 2/3 chance that the market will be higher. 1/3 chance will be that market could be lower. And that is why I always insist on, if you need money for next 3 years, and there is no scientific reason, but I say 3 to 5 years, don't put in the market. Because there is 33% chance that the market could go down next year. 33, 1/3 of, if your holding period is 1 year, if you need it for 1 year, yeah, there are 33% chance that it could go down. 68% chance it stays higher. Increase it to 4 years. 75% of the time in a 4-year block, any 4-year block, the market has actually gone up. There are, when I say 4-year block, it really means, let me make sure I can clarify this, is if you're looking at, this is 1871 to 2012. Pick any 4 years, any other 4 years, any other 4 years. 75% of those 4 years, the market has actually gone higher than where it was at the start of the 4 year. 25%, it has actually gone lower.
Is this inflation adjusted? Do you know?
Uh, Probably not. This is a absolute return.
Okay, so then for 30 years, it's 100%, but if you were to take into account inflation, that would change a bit.
So the idea is that the market has gone up. Now, how much it has beaten it's not talking about the return of the market. It's always
Just
telling
a
it.
nominal amount.
No, it's just telling that the 100% of the time market has actually gone higher than where it was at the beginning of a 30-year period. It could have gone higher by 10%, 5%. It doesn't talk about how much has it gone higher. Okay. So 20-year period and 30-year period, there's not even a single 20-year period you can pick up in which the market has underperformed. So let's say today we are looking at, right, if you're looking at 2021, if you invested in 2021 and right now let's say end of 2022, over this 2-year period, let's say end of 2020, starting of 2021, this 2-year period, market has gone down. You extend this 2022, go beyond, let's say go to 2002, it's still higher as compared to where it was in 2002. So over a 20-year period, market is still higher. And there is not even one 20-year period where the US market has actually not yielded positive return. Now, how much is the positive return? That we have not seen. But it is a positive return. So when you're talking about trying to timing the markets versus time in the market, that's all it says. And my personal experience has been the things that I started to pick up in 2013. This is where I started my journey in US. Those are still higher even after this whole crash in 2022. I've gone through 2018 crash, then I've going through this 2022 crash, but the thing that's where I've picked up in 2013 is still higher than that. So I think this is again an indicator of we have to figure out how to stay in the market and not get out of the market trying to think, okay, maybe I'll get back in when we don't know when we'll get back in. So interesting chart, but I've been believer of this. Only thing that the reason why I started doing options was how it can help me to elongate my holding period. If I can elongate my holding period to 20 years, then I'm sure that whatever I'm putting it now, 20 years later, is going to be higher than what it is today. Then why do I worry it has gone down tomorrow? It is statistically since 1871, there has never been a single 20-year period when the market has not returned. So that was an interesting chart that I'll share. And today what's happening in 2022 is pretty normal. I mean, market is down, only 17%. In a bear market, the average is 28%? What is 38%? We looked at some average. So it's still better than the average bear market. So we're feeling the pinch. It is maybe because we all came in 2021, or if you started investing only in 2020, yes, we'll feel the pinch right now. And there is, if you're looking for 2 years, 25%, there is a 25% chance that the markets will go down in 2 years. So what's happening right now is nothing unusual. This is how markets behave. All right, another interesting chart of 2021. Why 2021 is so outlier, and all the new investors that came in 2021, why we're feeling the heat is this was a period of irrational exuberance, a period of whole money printing in 2020, and everyone had money to spend, and number of IPOs is 1,035. And now there's an IPO drought. Even 173, I'm doubtful. I mean, of course, there are companies that go IPO, very small companies. We generally don't hear about in the media, or they don't get published in, in Wall Street Journal or any other place. So very few companies that I mean, this year, we haven't done any IPO analysis. I mean, Mobileye went IPO. This Instacart wanted to do, didn't go. I don't even think any other big notable IPOs. So this has been an IPO drought this year. That's interesting chart. I'll skip this one. But there was some comment around FTX. So let me go through this. Some comment about FTX. Yeah, Jay says it's still better than FTX creating token out of thin air. I trust the government will not default at least. Yeah. So yeah, if the government default, that's going to be a much bigger problem for all of us. Because right now all our money system is based on government. If we move out of government mandated money, then that's a different material.
Hey, Vivek.
Yeah.
Can you describe how the Chinese government could default? Because the bonds that it issues is to its own organizations within the country, mostly, and its own people.
Not always. So when these bonds are issued, like I said, on the treasury bonds, the players in the treasury bonds are.
Excuse me, I'm talking about China. I'm not talking about the US. Would you understand this?
So I don't know about in terms of the Chinese bonds. So at least I know in India, even in Indian, let's say if Reserve Bank of India issue bonds, those were owned by the corporates, those were owned by individuals also. I'm sure other central banks don't want to own Indian government bonds, right? Now on China, I don't know who owns those Chinese bonds, but I'm sure, let's say, because China being a big player in the economy, and there are other partners, trading partners of China, which are now holding yuan-dominated Chinese central bank bonds on their balance sheet. Maybe I can pull the stats later on in the next session, but over last 2 years, the percentage of the bonds held, yuan-denominated bonds, Chinese bonds held by the central banks has increased. Also, the percentage of the international trade denominated in yuan has been increasing. It's still very less than the dollar one, but the growth is higher. It's now, I think it's now 3% or 4%. It was 0 a few years ago. And the dollar denominated international trade is coming down slowly and slowly. I think now it is 65% or so. So
Vivek.
Yeah.
In Hong Kong, they started about over a decade ago, CNH, China offshore bonds, which, yeah, to issue to foreigners.
Yeah, it's what I mean. Like they do issue bonds, and citizens or anyone can buy those bonds. But those, like I said, every country, including US, China, citizens can buy those. Individuals can buy those bonds. Institutional individuals can buy those bonds, or the Chinese central bank could also buy the same bonds. But I am not too close to follow on the China market, so I wouldn't know about that. But that's my understanding. We're talking about housing, mortgage rates. So some scary charts is, these are the charts, not the housing prices, but the price cuts, right? Price cuts in Austin, Texas. And these are the charts from some of the hottest markets of 2020 and 2021. The number of houses on which the prices were cut is up almost 400% in 2022. And so from almost 860 to now 6,000 houses have reduced the prices. After initially listing, they cut down the prices. Same is the case with this graph is scary. In Phoenix, Arizona, Nashville, Tennessee. So we are seeing this is what called as demand destruction, right? Sellers are now want to sell, but the buyers are not there to buy because the mortgage rates are what, 6+%, close to 7%. So now they're starting to reduce the listing price. Raleigh, same stuff. Colorado, steep growth in reductions of listing prices. And on the other side, the buyers traffic, and this is as in November. Are the buyers going to, visiting houses to buy the houses? It's plummeted. It's gone back to where it was in early 2008. There's something called home buyer traffic index. Don't ask me how do they calculate it, but I'm assuming that they've kept the same calculations over these years. The interest by the home buyers to buy new houses is now as low as what it was in early 2008. So that's what this whole increase in the mortgage hours tells. Chindan say home prices are still listed over peak 2021. So price cut doesn't mean much. Yeah, right now it does not. But I think it's more symbolic thing now. Instead of prices going higher, it has moved into lower direction. We are seeing more price cuts as compared to last year. And this, when I say more, it's really percent wise, it's really huge. It's still higher than 2021. Yes. So that's why it still says that froth exists in the real estate. Still, it's there. It has more to lose. And I don't know. I don't have any predictions. But the numbers does tell some of the scary statistics on the property front. Right. Little more to scare you guys is SPACs and their losses. And more important is to look at the narratives, when these companies come out. And that's why it's so important to do your own due diligence and not depend on what CNBC says or what Jim Cramer says or what I say over here. Right? Skills is down 98%. Most innovative company in gaming and betting. Nikola, the Tesla killer, turned out to be fraud. Canoe, another Tesla killer. QuantumScape is down 94%. It used to be close to $90 share at some point of a time. I don't know where it is. DraftKings is down 83%. Monstrous revenue generating potential because this is online gaming, online gambling. And I thought everyone stuck at home, online gaming was the only way, but now didn't pan out. SoFi came through, all these companies came to IPO through SPAC. And now they are spectacular losses. SoFi is down 82%, leading next generation financial services platform. Lucid is another Tesla killer. Shares haven't performed great, at least since they're they're all down 90. Skills is down 98% of its all-time high. What the heck? Where is Skills? What's its SKLZ? Where is it trading now? Oh, it's below $1. It's become like a penny stock now. 394 market cap. Income is, of course, sales is $335 million and the market cap is 394. So investors are completely given up on this one. Oh, that's bad. So yeah, I mean, if we got drawn into these shares during the whole SPAC mania, tough. Oh, at some point it was $45. Yeah, it's tough situation. I'll be honest with you, and I'll always put a disclaimer. I did own DraftKings, right? And that is now like 83%. But it's like a dust portfolio position for me. That's why the position sizing is what saves you, right? I didn't have like 1%. I didn't have even 0.5% in DraftKings, but I know it's there in my portfolio. I bought it and it's down 83%, but doesn't pinch because the position size was so small. That is why the best thing that I've learned over years of investing, whether it was in India or in US, is position sizing, especially when it comes to individual stocks. You never know what those could do. They're extremely, extremely volatile. And I do recall some of them were talked about how these great companies are great, even on Jim Cramer shows. But no one has a crystal ball on what's the company gonna do and what's the market gonna do. So the only lesson I would say, if you want to take away from 152 sessions so far, is if you want to take only one lesson out of these 152, it is position size. You can go wrong on everything else. You can pick up the worst stock. You can you can enter in the market at the worst possible time. But if your position size is okay, you will live to survive and fight another day. Whereas if your position size is big, stock was great, future was looking bright, management was spectacular, analyst ratings were great, and you loaded the truck on that, everything else was great, but you missed on position sizing, there will could be a fair chance that it could just blow up your account. So one lesson is position size. That is the most important lesson. Whereas most of the investors, as investors, we don't even focus on position size. We focus on a lot of other stuff. We want to make sure that I cross all the T's and I dot all the I's before I want to invest. I'm like, no, if you have some decent understanding, I don't want to wait. I'll start small. It's only, I don't want to back up, the truck on it. If I start small, yeah, if it doesn't work out, it's okay. Do you have a link for the SPACtacular losses list? It was somewhere on Twitter, but I think there are a couple of websites that track all the SPACs. Maybe I can find this out and share that later with you. Those links were I guess, were in my favorites in 2000 when a lot of SPACs were coming out. I haven't gone to those links in many months. Another little scary chart is how's consumer doing and feeling. We already looked at that consumer is feeling the pinch of inflation. And right now, and this blue line shows you the credit cards and other revolving plans, basically the debts. And the red line shows you the saving rates. So way back in 2020, we turned the tables around and Americans actually started to save for a change. We saw the savings, percent jumped higher. Now we're back to a normal behavior where the savings is going down and the credit card rates have, the loan, credit card and the other revolving loan facilities, that is just shooting up. So I don't know how long it can continue before the consumers start to move to the desperate measures of, selling out. So this is where we see that the economy, this will plunge economy to recession, which is what Fed wants to do. Not recession, but demand destruction. Because I don't know how long can you carry on to take more and more loans before, you can't take no more. So right now, the difference between the loans and the savings rate is really, really high. So given 2022, this list, again, this chart is interesting. The biggest losers, billionaire loser list. This is one list where I want to be, call me loser, but put me on this list, I'll be very happy, right? But in any case, Zuckerberg comes at the top through metaverse. He lost $75 billion of his net worth. Microsoft, Google is down, what, 40%? Amazon is down, again, 40-50%. Tesla, same case. Crypto, don't even ask about it. and then this is the effect of Meta. One brand that we don't see here, and then we don't see it here as well. Oh, where's my tech layoffs? Where's that chart? Okay, yeah. And because all those market caps are going down, we also started to see a lot of tech layoffs happening. November has been the worst month, especially some of those biggies. Meta announced 11,000. They did 11,000. Amazon did 10,000. And Twitter did 3,500 when they initially, at the end of October. And now this week, another 75% chose not to stay with Twitter. So Twitter did massive layoffs. Other big number names you see is a Tesla in June, Booking Holdings in February. So and these are mostly tech. And tech are impacted because the Fed funds rate are higher. Many of these tech companies needs money to continuously grow because they don't generate any cash. And now if you can't grow because JP Morgan has decided to park that money with the Federal Reserve account, then you have to cut cost. And this is what we are witnessing in the tech industry is a huge cost cutting. But in this, nor in this, there is one brand, a big brand that we don't see in these two charts. And that's the fruit company. So Apple has slowed some hiring. And this is latest comment came from Tim Cook, is that a slowed hiring, but I know Apple, I think earlier this year, they fired some recruiters, but not really, not like mass layoffs like other companies are doing. What we are doing as a consequence of being this period being very deliberate on hiring. Apple is still hiring, but being very deliberate because Tim Cook says that strongly believe that you have to invest for a long-term growth. You can't save your way to prosperity. Your only way to prosperity is to invest. And this is one chart shows why Apple is such a strong company when it comes to the business, right? I know the stock probably is lower than from its all-time high, but from a business perspective, still a great business. Apple Services is a $80 billion annual run rate business, which wasn't even a business 5 years ago. Right? They never even gave this number separately of what the services business is doing because it was so minuscule amount. Right? But just the service business revenue is more than Netflix, MasterCard, Spotify, HBO, Warner Brothers, Discovery, all combined. Right? So, and that's why Apple is I'm glad that Apple is the largest individual stock holding in my portfolio, and I'm still happy to keep it in my portfolio. It's still a great company to own. Okay, this one I do want to talk about is on 18th or 17th, on 16th, Elon sends out an email to the Twitter staff overnight. It talks about going forward to build a breakthrough Twitter 2.0 and succeed in this blah, 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 blah world. The thing that we want to read here is, there is where it is. We need to be extremely hardcore. Means long working hours at high intensity. If you want to be the part of this new Twitter, click yes on the link below. And if you're not done so by 5 p.m. Eastern on Thursday, you will receive 3 months of severance. I mean, this drama never ends. So anyway, by 5 p.m. Thursday, what I read in the media is 75% of the people didn't click yes. So if you look at Twitter, Twitter, when he took Twitter, he already laid off 50% of the employees. Now, for remaining 50%, 75% have also chosen not to stay, but get the 3 months of severance package. So I don't know how, I mean, if we still continue to pull Twitter and work with it, great. But now they're operating on razor thin staff. Maybe that's good enough. And there was too much of a flab in Twitter. In that case, it's good. But I don't know if the people who are stuck in Twitter are stuck because they can't go anywhere because of the visa restrictions. That's one thought going around, is they have no other options but to stay with Twitter. Otherwise, 100% could have chosen not to stay with Twitter and with this dictatorial CEO. But yeah, Elon knows how to stay in the news. Right? And I think there was another one where he fired another person on Twitter itself with a tweet. Ramesh says, no one from this list buys Powerball ticket. That is true. They don't need Powerball tickets. They can sponsor a few though. So if say Apple has grown headcount much lower than the other FANGs in the last 5 years. So that clearly shows the management, the maturity of the management and how they want to, where they want to spend money. Right. James, Powerball is another form of regressive taxation. 30% of the cost of the ticket, not winnings, goes to state government. That I didn't. I know these governments make a lot of money through this ticket sales. 30% is a great number. EM is great at marketing and looking at how many people are discussing with Twitter in most. Okay, he is. He is. Don't get me wrong. He is the best media manipulator and marketeer Tesla, Twitter could ever get. Tesla spent $0 on marketing. Right? They don't have to. As a company, Tesla doesn't have to spend anything on marketing. They got Elon Musk. Right? He is great in terms of getting media attention. No doubt about it. Like I was talking, right? I jumped onto a space and Elon was there, and like 111,000 people were on that Twitter space. He knows how to pull crowd. But anyway, yeah, I'm not on, I don't know, on Twitter. If I was in Twitter, probably I wouldn't have stayed. But yeah, situation, everyone has their own preferences. And now we saw Amazon, they already laid off 10,000. And then Andy Jassy says that even 2023, we will continue to adjust. Now, what worries me is not that Amazon employees, but no one knows about consumer spending. No one has the consumer spending data that Amazon has, right, in terms of projecting consumer trends. So they're already saying we will have more role reductions into next year. Are they thinking what Prestor are assuming that there will be recession, spending will slow down, earnings growth will come down? Maybe. If that happens, then market could still go further down. But again, I can't predict. No one has been able to predict. Sometimes market probably bottom, and we saw, I think, of all the recessions, we look at the charts like last week, when the market actually bottomed down a few months before these bad things happened. So we have no idea. And the best thing is we don't need to have an idea of where the market will go. That's where the options help. All right. Let's talk about another thing in new news. Is Warren Buffett bought 60 million shares with the latest 13F filing. It took a large position in one tech stock, which is Taiwan Semiconductor Manufacturing. So we didn't see this company in this big list. Or not many know about this company, especially if you're not in a semiconductor industry. Not many people have heard about this company. This is a Taiwan Semiconductor Manufacturing company. As the name suggests, it's a semiconductor fabricating chips manufacturing company based out of Taiwan, now building plants in US and Berkshire Hathaway picked up 60 million shares of this company at a stake of almost $4.11 billion. Right now, it has become a top 10 holding of Berkshire Hathaway. Okay. Why? Because this company is a high quality company in terms of the business side. I don't have to talk too much about it. I think I've spoken a lot about this and ASML. And why I hold these is it's got 90% market share of the high-end small, the nanometer chips. Less than 7 nanometer and less 5 nanometer, 3 nanometers. TSMC has got 90% market share. Of all the semiconductor chips that are created in the world, TSMC has got, I think, between 60 to 70%. And we going more and more digital, AI, robotics, robotaxis, metaverse, connected fitness, connected appliances, everything needs chips. Nowadays, cars have more chips than probably the computers have. So we will continue to have a need of more and more chips. Then the biggest player in this chip manufacturing, which is TSMC, and they have such a strong hold on the overall, the high quality, the most recent advanced chips, 90% is produced by TSMC. It has become so important that it is becoming a thorny. The only reason why US is interested in Taiwan, in saving Taiwan, is because of TSMC. If TSMC goes under, the rest of the world goes under, because we can't get those chips. Apple cannot get the chips for their iPhones if TSMC goes down. Intel doesn't produce those chips. Samsung doesn't produce those chips. Or let me put it, Intel definitely doesn't produce, because they don't even have a capability of that fabrication plant to produce 5 nanometer chips. Probably Samsung does, but then 90% is produced by TSMC. So this has become such an important company for the whole world that we are ready to go head to head with China just to save TSMC. I don't hear about any other big Taiwanese company that's so important to US and the rest of the world. But this is, that's why US government is trying to make overtures with Taiwanese government, because we are afraid that if China takes up Taiwan, we're caught naked. We are dead in the water if we don't get this TSMC chips. And to de-risk that's why TSMC is now building plant in Arizona, because US does we don't want to be left behind if China attacks Taiwan. So that's why we're asking, and the TSMC is building that plant in Arizona. And they have a strong moat, because if you look into the chip manufacturing process, it's not easy to build that knowledge. Those recipes are built over years. The whole process is like probably more than 1,000 of steps. It's not easy to replicate that. If it were, Intel could have done it. The reason why the Intel shares has been lagging is Intel is still stuck with the old 10 nanometers. Probably. I think maybe Intel makes 7 nanometer. I don't know. Anyone please correct me. And Siv, you are in chip manufacturing, right? So you probably know. Does Intel make 7 nanometers yet? Sorry to put you on spot. Okay, Eugene says they do. Probably not 5. I know Intel's capability is far less than what TSMC does. So let's pick Intel chip. I just tell you what all do they make is Intel has 7 nanometer. TSMC 3 will go in production. Intel 4 formal nodes. Okay, Intel does have a 7. It will go in 2022. Okay. Intel is still stuck at 7, whereas the TSMC is actually moved to 5 and 3. Okay. So yeah, I mean, Intel is trying to catch up now. Asif said, does that mean Buffett knows not worried about China, Taiwan tensions? So I think this is like too big to fail kind of a stuff for the whole world. So I don't think we'll let TSMC, go out of business or let China, even if I don't, because this is too big to fail. So I guess that's what Buffett, and I don't know. I didn't read 13F. I'm not even sure did it, if he had, did he put out what's the reasoning behind it? I have no idea. I only know the numbers that were reported, but this is too big to fail kind of a company for the whole world. With Buffett buying huge number of shares of TSM, there will be more pressure on US military to protect US corporate interests. Yeah, but it's right now it's only 5 billion, but we did see a huge jump in TSMC price after Buffett bought these shares. So yeah, it's, I mean, the ride hasn't been smooth. If you really look at TSMC, the ride hasn't been smooth. I mean, just like because semiconductor is such a cyclical stuff, and so it has somewhat on 137, just down to 60, and I think this is last 2 days when Buffett bought it, we saw a sudden jump from 60 to almost 82. Eugene says TSM uses a lot of EUV technology, a lot more than Intel. Yeah, and when it comes to EUV, there's another stock that we talked about last week. And again, now this is one of my top 10 holdings is ASML, the only company with absolute 100% monopoly on the EUV machines. So we're happy to hold them in portfolio. Eugene has some interesting stats. I believe they are ahead in tech nodes 4 versus 7 because they invested more into buying. Oh, okay. Oh, so this is what you were talking about, ASML litho tools. Samsung TSM 3 nanometer, Apple 5 nanometer, Intel 7 nanometer. But Apple doesn't manufacture its own chips. So Apple designed 5 nanometer chips and they basically contract out the manufacturing to TSM. And even AMD, it's also fabless, right? So these are called fabless chip manufacturers. I mean, they don't manufacture chip, they design it, and then the TSMC will manufacture it. Global Foundries will manufacture, Samsung will manufacture for these companies. So if TSMC goes under, Apple goes under. So yeah, huge, big, it's too big to fail for the world. All right. And anything else? Yeah. So it will start buying chips from a factory in Arizona in 2024. Okay. And I think I already talked about that. Taiwan is going to build a semiconductor factory over there. Pain now, gain later. Warren has been a traditional tech, not been a traditional tech investor, but he picked Apple. Has worked out great for Berkshire. TSMC shares are down 50% from the 52-week high. We recently saw it 132 to 62, and I think that was an interesting entry point for Berkshire. So picked it up. Even now, it's down 30% year to date. But given how Berkshire operates, they're looking at much, much longer term. So yeah, something I wanted to share what Berkshire was buying. And now we come to the last portion, which is our earnings. Anything to say on MediaCom versus Qualcomm, as the former has a UW5G processor? No, Sam, I've never looked at Qualcomm. I know it's a great company. This is one stock which I never bought or never dug deeper into Qualcomm.
Oh, Vivek,
Yeah.
Qualcomm actually sucks as a stock. I bought it in 2013. I should have also bought Apple. Qualcomm has barely doubled. No, it's a lousy stock. If you bought it in 1996 to 2009, maybe it was good, but no, Qualcomm is not a very well-run company.
So yeah, you said you bought in 2018, 2019, and it has only doubled, right? So that shows us the expectations that market has set for us, right? Only doubled in 4 years. I would say that has done great. Double in 4 years, where do you get that? But now, I mean, as an investor, if you're trying to compete with Apple and others, of course, but double in 4 years on an average, market returns anywhere between 8 to 12% per year. So Qualcomm has probably beaten S&P 500. So then from that perspective, I'll still say it's a good stock. But unfortunately, if someone got into Qualcomm here, yeah, they're feeling the pinch, right? But look at since 2011 or 2012, like 10 year, they're almost, doubled, which I still, it's not bad. You could have gotten this through your bank CDs or through S&P or through your treasury bonds. Tone down our expectations as an investor. I think we need to learn toning down our own expectations. We've been spoiled in 2000 or last 10 years. Let me put it that way. We've been spoiled by the markets always going up in 10 years, last decade. Now is where the market is becoming more real. That's how it usually operates. Okay, jumping to earnings. I don't have the details of these, but tale of two retailers. After earnings, Target was down, and after earnings, Walmart was up. Another indication of economy and how consumers are feeling the pinch. Walmart, everyone knows, everyday low prices. These are the essentials you go and buy at Walmart. You can skip the things that you used to buy at Target, any expensive stuff, discretionary purchases. Of course, Target has got its own problem of inventory management, but good to see these numbers posted by Walmart. It was up almost 5%. Walmart doesn't jump 5% in a day. That's very unusual, but this shows the strength of Walmart. And I would say, let's say, I don't know if those dollar stores have announced their results or not, but if economy continues to stay so tight, goes into recession, consumers will feel the pinch and will gravitate towards the cheapest price. So we should see those dollar stores or Dollar Generals, and even those super discount stores like TJ Maxx's and Ross's. They do good when the economy is doing bad, and vice versa, let's say for Targets and others. But we saw opposite reaction from the market to the two retailers. I don't hold any of these in my portfolio. I used to hold Walmart, but I think in a covered call, it got sold at, I don't know when. And over this whole year, it's not just this earning, but overall this whole year, Target is down 30%. Walmart is barely keeping its head above water. So that's on Walmart and Target, or Target, as some people would like to say. All right, next one I want to talk about is Jumia Technologies. So-called, earlier it was called Amazon or Africa. Don't do those comparisons anymore. Any of those comparisons like Amazon or Africa, Netflix of China, Amazon of China, those stocks haven't done great. So be wary of those comparisons, but I still hold this in my portfolio. Again, my thesis is 15 to 20 years. E-commerce is not easy to make money, so I'll continue to hold. And that's why I do look at its earnings every time when they release the earnings. So let's jump into the earnings of Jumia. Anyone holds Jumia over here in this group? Then I can skip it. Okay, Ramesh says it did. Okay, then I'll skip this one. But this is a stock that has gone places, many places around over last 1 year. Where is it? It's the daily stuff. This is the daily. It's been to many places that or last 1 year, as high as 2021. So some point of time it was as high as $60. In 2020, it was as low as $2. So $2 to $60 to almost $5. This company is more into setting up e-commerce in Africa and many various countries of Africa. So you really need to have a long-term investing thesis if you want to invest in this, right? Ramesh says took loss last year. P. Shanks, I'm going to sell to claim loss. Yeah, if you're holding this and want to take your tax loss, maybe it's going to take time for it to even recover, if it recovers. But anyway, won't go into details, but quickly skim through it. The focus on this company has been to grow profitably. And at least in this quarter, they reduced their EBITDA loss, reduce their marketing spend, and trying to focus more on the Jumia Pay, which increased 58 basis points. The penetration of their payment platform is looking okay. And biggest thing is on their marketplace revenue, which is where the Amazon started to focus on. That is growing 27%. That is growing at much faster rate than their first party revenue, which is where essentially they're following the same playbook what Amazon did, but with an additional twist of adding a payment platform, right? So that's all. So I'll skip this one because none of you actually hold it. So I still hold it in my portfolio. I should go back and look, do a whole analysis and see, okay, what happens every quarter. Two things happened. One was the founder and the co-CEOs. They have been moved out. So big shareholders that do want a change, they want to focus and move towards profitability sooner than later. And so this one, e-commerce marketplace, already talked about. Jumia Pay grew, but grew very less because there's a tough comp. Logistics, good to see that they're reducing their focus on logistics. This was a new business that they started in 2020. And because 2020, everyone was starting new businesses. Now they're trimming back the focus on it. I still hold it in my portfolio. Average buy price was almost $30. But right now the current cost basis is 15. So 2 years, 50% down. I will continue to sell covered calls and reduce the cost basis, right? So this year, my cost basis has been reduced from 1580 to 1504, almost $1, which means even the stock has performed so bad, I'm still able to reduce my cost basis. Our thesis on this is minimum 10 years. So right now I'm in this only for 3 years so far. So I have still more 7 years to go before I think to dump my shares, right? And in 3 years, I've got my cost basis from $30 to 15. Maybe another 5 years, I can bring this to zero so that I own it free and clear and that don't have to worry about where it goes. I said chose to hang on Melee and Shop instead. Yes, I hold both of them in my portfolio also. I have Melee and Shopify. I only picked up in 2021. Oh no, incorrectly. I had some Shopify in 2018 or 19, and then the short seller report came. I only had invested like 20% of what I wanted to invest, and then I read a short seller report and then didn't buy anything didn't buy Shopify. And then 2020, it was out of my reach. 2021, it was out of my reach. Now it has come back down. So this year, I actually bought Shopify. But Melee I have been having for a few years. So that's skip Jumia, but maybe the next one probably more of you probably hold in your portfolio is Nvidia, and this is the last company for our earnings review today. So let's look at Nvidia, and we will also look at what company doesn't talk about. So when you look at these headlines, they talk about data center review up 31% from a year ago, and a return to shareholder, quarterly return to shareholder is 3.75 billion, which means the dividend plus the share buyback. So they returned 3.75 billion back to shareholders. Data center revenue grew. I'm like, okay, what else? Because Nvidia has multiple revenue streams. Data center is just one of them. So let's dig into this. Hold on. So let's dive. Okay. Yeah. So Nvidia says that returned $3.75 billion in share repurchases and cash dividends, bringing the return for the first 3 quarters to 9.29 billion. So probably, maybe they'll do, if I take the same average, maybe they'll have almost $13 billion of return to shareholders in this year. But if you really look at it, if you bought back shares, I don't see any difference, much difference between the share count. These are the diluted share count. Not much has changed. And these are, so it means somewhere, so on one side, you're buying back the shares. On the other side, you are also issuing the shares. So when you look at these headlines, we should also go back and check, okay, what else is happening? I don't see this count going down drastically. And then you look at the cash flow and you look at stock-based expense, that expense has gone higher. So while they're buying back shares, but they're also issuing shares to the employees, which is increasing the share count. So essentially, as an investor, I'm like, what changed? Nothing much has changed on the buyback perspective. Of course, you bought back, but then you issued more shares to their employees. So it's important to look at these when companies talk about the buybacks. Let's look at the summary, right? Revenue is down 17%. Right? They don't talk about these things in headline, right? Headline is data center revenue up 13%. Overall revenue is close to 5.9 billion, down 17%. Gross margin was down. Operating expenses were up. That's why the margins went down. Operating income down 77%. Net income down 72%. EPS is down 72% year over year. So very, very, very tough comp. And we are comparing it with 2021 Q3, which is where all these companies had one of the best quarters. So I understand that when you're comparing to year over year, the comparison is very tough. Quarter over quarter, little better, right? But let's dive deeper into their 3 businesses. Outlook, nothing much. Data center revenue grew up 31% year over year. Gaming is down 51% year over year. We shouldn't be surprised about it. Kids are back into schools. Many people have gone back from working from home to now working in offices. So you can't play those many games. But I know, some people still steal to play games in office. But anyway, your office is not going to provide you with a gaming laptops, right? So anyway, folks getting back to work, kids getting back to school, games, those gaming chips are low in demand. So that revenue is down 51% year over year. Third one is segment is professional visualization. This is where the metaverse and all that stuff, that is down 65%. It includes metaverse, smart cities, and all that stuff. Fourth one is automotive and embedded systems, which is up 86%. So overall, if we put a summary, data center is growing. gaming, which used to be, it used to be one big part of the business. It means last year they did almost $3 billion in gaming. Now that is down by 50% year over year. So short term, I do see some headwinds. It's tough comparison for Nvidia, but overall, the type of partnership that they're building and the overall strength that they have in high-end computing is still, they're still strong, right? Forming up the collaboration with Microsoft, Oracle, Nuance. 90% of the supercomputers actually use Nvidia. So, but you really need to have a little longer term focus on this one. Other clouds is a crypto crash because of the processors that were earlier used in cryptocurrency mining. Now the crypto winter is setting up, and now like Ethereum has moved from mining to proof of stake. So all those GPUs are now available in market for anyone to buy from a secondary market. So that's why the so on the gaming basically sells GPUs. Now there's a glut of GPUs coming from the crypto market. Also, other thing was the government restrictions. So management estimate that this whole government restrictions from a US government, for selling chips to China impacted $400 million hit to their revenue. And lastly, I saw they're burning a lot of cash. So stock-based, even accounting for $745 million of stock-based compensation, still the net cash was only $392 million, right? Worst thing is accounts payable is now negative, means they got paid upfront in previous quarters. So, and they have to deliver a lot of these services. So they're burning cash. That's what I'm saying. Looking at a short term, for me, it's a short term. There are some headwinds, but long term, I think the story is intact. So be careful on this one if you're trying to get into from a short term perspective. Yeah. So that's on Nvidia. I do hold Nvidia in my portfolio. Now for next week earnings, nothing much. I don't think I hold anyone in my portfolio directly. Oh no, I do hold a little bit of a Baidu. Yeah, but not a big. Cool. So that's all about earnings and today's sessions. Alrighty. Any questions? Cool. All right. So that's it for today. Then thank you everyone for your time. Enjoyed talking to you, going through all this content, and thank you for being patient audience. Hopefully you learned something. I learn every week when I come here. I learn, I enrich myself with all the knowledge. Want to learn more about the markets, and we'll continue to. Learning is always continuous. Learning should never stop. So I do want to focus on continuous learning. Do you recommend any podcasts? Yeah, I do have a bunch of podcasts. So let me take a name. Next week, I'll start the session. Maybe give you the list of podcasts. I took a note of it. We're going to talk about that. Yeah, podcasts are my friend when I go out for a walk, or, if I were to drop my kid somewhere, I have to wait out. That's my pastime, is listening to some of those podcasts. Cool. All right, then. Thank you, everyone. We'll talk again next week. Bye-bye.